Hey everyone, Ben here. Howard Marks is one of the greatest investors of all time. As founder of Oaktree Capital, he manages over $120 billion, and his investment firm has averaged around 20% per year, smashing the S&P 500 market index. So in this video, I'm going to dive into a recent book which I read of his called The Most Important Thing. Now, it's quite a long book, there's various different aspects to it, but what I've personally done is highlighted certain parts which I think are really important, the most important parts of the most important book, and then I've distilled that together to present to you guys so you guys can digest this wisdom easily and fast. So this is going to be a really great video, especially for those who want to take their investing to that next level. This is really advanced investing strategies. It's not really going to have stock picks in. It's not really going to have hype. This video is probably not even going to do very well on YouTube, but I'm going to make it anyway because I think it's really valuable information which you guys should know. So this is a video where you need to pay attention, and I think you'll like what I've got for you. Before we dive right in, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. And if you do find any value in this video at all, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you guys want to know exactly which stocks I'm buying, which stocks I'm selling, and access my entire investment portfolio and join a thriving community of some of the finest people on the internet, then be sure to check out that first link in the description below for the VIP membership group. And I'll also be putting this presentation in the VIP group for all you guys to download. And with that being said, let's dive in. So just a few quotes to start us off. Experience is what you get when you didn't get what you wanted. Good times teach only bad lessons. That investing is easy. So investing isn't easy. It's easy in the short term, but in the long term, to be successful at it, it's an extreme skill, and it also requires a lot of luck. So firstly, we're going to kick off with what's called second level thinking. So this is basically taking a step back and looking at a different situation. So let's say you see a situation, a stock is really popular, everybody's talking about this stock. I'm going to use the example of Tesla just because everybody knows this company. Extremely popular company, everybody knows about this company, everybody says it's a great company, everybody invests into this company. First level thinker will follow the crowd and say, okay, that's a great company, I'm going to invest into it. That's what a first level thinker will do. A second level thinker will take a step back and say, oh, wait a second. If everybody loves that company and it's a really popular company, then that will mean the price of that company and the valuation for that company will be extremely high. Now, Tesla's always had this problem, but I'm just talking in general. As more people invest into a popular stock, its valuation will become extremely high. Thus, a second level thinker takes a step back and says, okay, well, instead of buying that stock, I'm actually going to sell that stock and buy a stock which nobody cares about, it's unpopular, and everybody hates. And that's second level thinking. So basically, when investing, we're looking for mispricings in the market. That's what we're looking for. And the oldest rule in investing is, of course, buy low, sell high. But rarely many people actually do this. Section number 2 is growth versus value investing. Now, this has been a popular debate. Cathie Wood versus Warren Buffett. Growth versus value investing. Now, I personally consider myself a combination of a growth investor and a value investor. I'm not as strict as the traditional value investors, and I'm not as crazy as some of the pure play growth investors. Try to find that middle ground, that balance, that growth at a reasonable price, or GARP. Value investors aim to come up with a security's current intrinsic value and buy when the price is lower. That's called a margin of safety. Now, growth investors try to find securities whose value will increase rapidly in the future. Basically, the choice isn't between growth and value. The choice is between value today or value in the future. And basically, Howard Marks' point, he's a traditional value investor, is that predicting the future is extremely hard. Thus, being a value investor offers a lot safer and more sustainable returns, although admittedly not as exciting. So growth investing represents a bet on a company's performance that may or may not materialize in the future, while value investing is based primarily on analysis of a company's current worth. So the difficult thing with value investing is, let's say you buy an underpriced stock and you have that margin of safety, then it can take a very long time for the market to actually wake up, and that's assuming your investing thesis is right and actually correct to that price. Howard Marks says being too far ahead of your time is indistinguishable from being Wrong. So that's clear. Imagine you invested into Bitcoin, let's say just after the major crash in 2018, because you had an investing thesis that it was going to increase in 2021. Now, let's say you did that. You're going to look like an idiot for the next 2 years until it does increase, and then you're going to look like a genius. And that's value investing, but with stocks and not Bitcoin. Here's a little joke here as well. Warren Buffett opens a new restaurant. I've said this one before, and he calls it Warren's Buffet. Right, okay, no more bad jokes. Let's get onto it. Section number 3, can you pay too much for a stock? And the answer is yes. Sorry, guys, you can pay too much for a stock. I know this is going to offend a lot of people because people are bullish on a lot of certain stocks despite the valuation, but you can pay too much for a stock. And these are not just my words. These are the words of the great billionaire Howard Marks. So this is what he says. You can pay too much for a stock. So the relationship between price and value investment success doesn't come from buying good things, we need to remember that, but rather from buying things well. It's been demonstrated time and time again that no asset is so good that it can't become a bad investment if bought at too high of a price. Now, I'm going to use Tesla as an example again. I've got nothing against Tesla. I think it's a fantastic company. I am a shareholder of Tesla also, but it doesn't mean no matter how high that stock gets, that it's still a great investment. If this company reaches $1 trillion, which it probably will by the time this video comes out, then that doesn't mean it's still a great investment at those levels. We need to constantly reassess the valuation of Tesla, reassess the future valuation of Tesla, and then make our own investing decisions and just look where the best opportunities are. On to section number 4 is bubbles. Now, this is a really big one. I'm always getting questions. Ben, are we in a bubble? Is the stock market about to crash? Well, investing in the short term is a voting machine. It's a popularity contest. But in the long term, it's a weighing machine based on fundamentals. And this has been proved time and time again. So investing is a popularity contest, and the most dangerous thing to buy is something at the peak of its popularity. Now, I've been there myself. Back in 2018, when Bitcoin first had its major bull run, I actually got in quite late, near the top of that bubble. I didn't really know too much about investing, the same as I do now back then. I got in quite late. It went up, I sold some Bitcoin, I made some profit, and then it crashed and I lost quite a lot. But really, I didn't actually lose it because I just left the money in that account from 2018. I left the Bitcoin in that account. And then 2021 came around and it actually skyrocketed again. I was actually shocked. And I did sell out of my Bitcoin once it skyrocketed to all-time highs. Can get a little bit lucky like me, but in general, it's not good to buy things when they're extremely popular. You need to be the first on the scene. They say what a wise man does at the beginning, a fool does in the end. And you don't want to be the fool. You want to be the wise man in the beginning who takes the risk and bets on something which everybody else hates. Now, the problem is in bubbles that attractive morphs into attractive at any price. And I see this time and time again. People think because something's a great company, it means at any price it's still great. That's not true. Imagine a Ferrari. Ferrari's great. It might be worth $500,000, $300,000 according to the valuation, and many people will buy it at those levels. But is it worth $1 trillion, a Ferrari? Not really. It's a nice car, but it's not worth $1 trillion. That's the market cap of a company like Apple. All bubbles start with some nugget of truth, and I think this is the deceptive thing about bubbles and why it makes them so difficult to actually discover and find out when we're in a bubble, because they all start with a nugget of truth. For example, there was a tulip bubble in Holland, and tulips are, of course, beautiful and rare, and they had a major bubble where people were paying massive amounts for tulips. And then they had the dot-com bubble in the late 90s. So the internet was going to change the world. That was the thesis, and the internet did change the world. You're watching me over the internet streaming right now. So the internet did change the world. The people who invested into the internet stocks did have the right investing thesis, but they just paid the wrong price for those highly priced internet stocks. So here's one of my favorite charts, and that is the chart of a bubble. So as you can see here, it starts off with the smart money. So the smart money, this is the wise man. This is the person who in the stealth phase buys an asset which everybody else hates, doesn't like, because they see a different angle, let's say an information edge on that stock. And then institutional investors might move in, and then the public moves in, the retail, enthusiasm, greed, delusion. And this is what I know. When it's on mainstream news, when you see about a certain stock, about a certain asset on mainstream news, and they're talking about Bitcoin, your grandma rings you up and says, are you going to buy some Bitcoin or are you going to invest into Tesla? Then to me, that is a real red flag. And that is when you should think of selling, because that's when the people that don't really know about investing, they're getting into, and that's when you know it's extremely highly priced. So that's just something to be aware of. I actually saw this with Bitcoin back in 2018. It was actually on mainstream news and TV. My own mother rang me and said, Ben, I've seen about this Bitcoin and you're not investing. I said, whoa. That's when I was selling. And then I started selling the Bitcoin, but I didn't sell enough of it at the time. So, of course, it reaches to a new paradigm where people say, this is the new normal. The stock market can't crash. And then we have denial, and then we have a major crash, and we have capitulation and despair. Now, I don't want that to happen to you guys, so we just need to be aware of what can happen in these crazy bubbles. So the theory at the moment is the Fed can keep printing money to protect the stock market. There is a major myth going around right now, and that is the Fed can control interest rates. And the simple fact is, I actually heard this from a valuation professor at New York University. The Fed can't control interest rates. They can only influence interest rates. And the issue is, when interest rates rise, let's say this is caused by inflation, then investors have other places to go. They could go into bonds because the interest rates are high, and this can affect the stock market. So historically, this has. So here's a chart here, interest rates versus the stock market. We can see every time interest rates have risen, that's in black here, the stock market has declined. So in 1981 here, interest rates shot up sky high, and the stock market declined. So they are inversely proportional. At the moment, in 2020, we can see the rates are really low. It says 2010 here, but it's the same with 2020. The rates are really low at the moment. Thus, we see the stock market at highs, and we saw that here also with the dot-com bubble. So how long do bubbles last? Well, this is the difficult thing with bubbles. Nobody knows. Nobody knows how long a bubble will last. It could last for 5 years, 10 years, 1 year, 1 month. Nobody knows. And that's the difficult thing, because if you're sitting on the sidelines and you're not investing because you think we're in a bubble, then you could be missing out on some major opportunities. So I think the best solution is to be strategic about your investments. Now, one thing we really need to flip our mind around on is that risk actually increases during upswings. So the more highly priced stocks get, that actually increases the risk. So it's the opposite of what conventional thinking is, first level thinking, which basically says when there's a stock market crash and stock prices are low, that's dangerous. But really, that's the safest time because stock prices are low. So we need to flip our mindset. When we see stock prices getting higher, that's when we should start being a little bit more cautious. Okay, on to point number 5 is risk. So risk means more things can happen than will happen. So in order to attract capital, riskier investments have to offer the prospect of higher returns, but there is nothing to say those higher prospective returns have to materialize. So the conventional wisdom is higher risk stocks actually produce higher rewards, but the truth is that's not guaranteed, because if those higher risk stocks, those higher risk assets actually consistently produce higher returns, then they wouldn't be higher risk. And this is what Howard Marks makes as his point here. So with riskier investments, let's say a micro cap company, let's say a penny stock, let's say a SPAC, risky investments are those of which the outcome is less certain. So that is the probability distribution of returns is actually wider. So that's what we just need to take into account. But what do we want as investors? Well, of course, we want low risk, high return. So to get that, Howard Marks states that we need to pay less than the fair value of a stock. And this seems pretty obvious, but it's rarely seen in the market. And what the opposite of that is of course, high risk and low return, and you get that from overpaying for an asset. So there's a great quote here by the great Warren Buffett, and he says, it's only when the tide goes out that you learn who's been swimming naked. And of course, there's a nice picture here to inspire us all, but yeah, it's so true. You only learn who's been taking immense amount of risk when things go wrong. And that's what you learn in the stock market. So there are 2 types of risks we need to think of. The first risk is the risk of losing money. And the second risk is the risk of missing opportunity. So we need to balance the 2 out in order to get the best investment returns. You don't want to be fully fearful all the time and just sit on the sidelines in cash and not invest into anything, because then you're missing out on the major returns of the stock market. But you don't want to be that crazy that you just invest into everything and you're not really taking in valuations into account. I absolutely love this quote. Trees don't grow to the sky and things rarely go to zero. So it's basically saying stocks don't go up forever. They do have corrections. They do have crashes. Certain stocks will not keep going to the moon, and things rarely go to zero. So when you see something declining, and it looks like that company is going to go bankrupt, then rarely that actually happens. So this is quite clever. So when everyone believes something is risky, their unwillingness to buy usually reduces its price to the point where it's not risky at all. So broadly negative opinions can make it the least risky thing, since all the optimism has actually been driven out of that stock. However, conversely, when everybody believes something has no risk, a stock is a blue chip company, it's got no risk, then many people invest into those stocks and they can actually become risky. We saw this with the big blue chip stocks back in the late 90s and early 2000s, such as IBM. Everybody said you can't get fired for investing into IBM. Many people did, and IBM didn't turn out too well. This outstanding investors, in my opinion, are distinguished at least as much for their ability to control risk as they are for generating return. So if we control risk first, we understand risk, then we can generate higher returns. On to number 6, and that is to understand probabilities. Investing is all about probabilities. What is the probability of this going to happen? What is the probability of that going to happen? How is that going to affect your portfolio? So the expected result is calculated by weighing each outcome by its probability of occurring. Now there's a big difference between probability and outcome. Probable things fail to happen, and improbable things happen all the time. Even in an extreme situation, a black swan event, how will our portfolios hold up? So I love this quote as well. So be aware of the 6-foot man who drowned in a river which was 5 feet deep on average. So on to number 7, it's understand the role of luck or randomness. So appreciate the role of luck and randomness in all our stock market decisions. Every time we invest into stock, the outcome is based not just on our investing skill, but also on luck and randomness. We need to understand if that stock has gone up because we were lucky or because of our investing skill. And usually it's a combination of both. And it can even happen the other way around. So say you have a stock in your portfolio, it's underperforming, really bad stock, and you might be looking at that and thinking you're stupid and thinking you made a bad decision, but you actually might have made a great decision at the time. It's just the outcome is not showing that at the moment. So don't beat yourself up sometimes if you see a stock that's down. That doesn't mean you made a bad decision. 4-day weekend! And here's an interesting one here. So $10 million earned through Russian roulette does not have the same value as $10 million earned through diligent and artful practice of a system. So every once in a while, someone makes a risky bet and they look like a genius because it's right. But that doesn't mean it was the right decision. Robbing a bank is a very risky thing to do, and because there's a high chance that you're going to get caught. If it pays off, does that mean it was a great decision? Could you repeat that process again and again and again? I don't think so unless you're in Ocean's 13. So this can commonly be called survivorship bias. So just because someone has a stock in their portfolio and it's gone up by a lot, then they may think they're a genius and their strategy was correct, but it might not have been correct at the time. They just might have got a little bit lucky. So at a given time in the markets, the most profitable traders are likely to be those who are best fit for the latest cycle. So the easy way to see this is that in boom times, the highest returns often go to those who took the most risk. I do like Crafty Wood, great investor, but her portfolio, the ARK portfolios, were perfectly set up for the whole global issue which happened in 2020. And that's why ARK funds benefited massively. Here's another ludicrous example. So imagine you built a ski resort in Miami, which is known for, of course, its hot temperatures. Then 3 months later, a huge blizzard hit Miami. There was snow everywhere. And of course, you've got a ski resort. You benefited massively and you become a multi-millionaire. Was that the right decision to make? Well, no, it wasn't the right decision to make. You just got really lucky. You need to appreciate that you got really lucky and you made millions. But generally looking at the probability distribution, that is an extremely unlikely event which happened with regards to this blizzard. And you benefited, yes, but could you repeat that process again and again and again? Invest only when you're convinced the likely return far more than compensates for the risk. So this is not risk aversion, this is risk intelligence according to Howard Marks. So Howard Marks, although he assesses risk first, he actually invests in some of the riskiest assets. So even risky assets can become good investments if the price is right. And that's what Howard Marks actually specializes in investing into. He invests a lot into what's called distressed debt. But to put it simply, buy when they hate him and sell when they love him. On to number 9, and that is investing cycles. So this is what we need to know. Everything in this world is cyclical and things don't go on forever. The market fluctuates between fear and greed, between optimism and pessimism, and our goal is to understand where we are in that current cycle in order to take advantage of those opportunities as investors. So investors will overvalue companies when they're doing well and undervalue them when things get difficult, and we can take advantage of that as investors. But the difficult thing is we don't know how far the pendulum will swing. We don't know what might cause the swing to stop, but we do know a reversal will occur at some point. So here's a classic market cycle here. We've got optimism here, exhilaration, euphoria, and usually at the peak euphoria here, that's actually the best time to sell. And then it goes unease, denial, pessimism, panic, capitulation, and despair. So that's actually the best time to buy. Contrarian is basically somebody who bets against the consensus and is right. And a famous contrarian investor is Sir John Templeton. So this guy was actually investing during World War II. You've heard the phrase, invest when there's blood on the streets. That's what this guy was doing. Literally. And it turned out he was actually right. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Or as Warren Buffett puts it, be fearful when others are greedy and greedy when others are fearful. One of the famous quotes of motivation to invest. If you watched this channel back in March, April 2020, I was preaching this quote on this channel, and of course those who listened made some major gains in the stock market. So on to number 10, what is our investing strategy and what weapons do we have? Well, these are Howard Marks' weapons which he uses in the stock market. So he has a strongly held sense of intrinsic value for the stocks he's looking at. He has an insistence on acting when he sees prices diverge from that value. So he doesn't get scared out of situations when he sees opportunities. He has an awareness of cycles and where we are in those cycles at the moment. And he also has an awareness of the insidious effect of psychology on investing. Fear, greed, FOMO, these can all affect our investing decisions. And on the fifth point, he has a promise to remember that when things seem too good to be true, they usually are. Point number 6, willingness to look wrong when the market goes from misvalued to more misvalued, as it invariably will. So, and finally, point number 7, join a like-minded community from whom to gain support. This is a serious point, but basically I think he means subscribe to this channel if you haven't already. Hit that thumbs up if you're finding value so far, and let's get on to the next point. On to number 11 is portfolio construction. So how do we construct a portfolio using these points we've learned? Well, basically this consists of buying the best investments and making room for them by selling lesser ones and staying clear of the worst. It's that simple. So we need a list of potential investments, estimates of their intrinsic value, and a sense for how their prices compare to their intrinsic value. And then we also need to understand the risks involved in each of those potential investments. Where to find great investments? Well, I personally believe we need to turn over a lot of different rocks in order to find those gems. Controversial or even scary industries. For example, the great investor Peter Lynch is famous for investing into funeral companies, and he actually made an absolute killing, pardon the pun, because many people did not actually want to invest into a funeral company, despite them being heavily profitable. You can also look for companies which have a lot of bad news against them. They're unappreciated, they're unpopular, and unloved. So as investors, we can show those stocks some love. And with that being said, I hope you guys did find some value in this video. If you did, feel free to give it a big thumbs up. Feel free to subscribe if you haven't already. If you guys want to access all my investing books, which I've read over a period of time, I've actually got a full Amazon store after many requests from you guys. So I'll leave a link for that in the description below. If you want to access exactly which stocks I'm buying, which stocks I'm selling, and my entire investment portfolio, and join a thriving community of some of the finest people on the internet, then feel free to check out that first link in the description below for the VIP membership group. With that being said, thank you guys so much for watching. I have so much love for you guys continuing to support this channel. I hope you all have an incredible day, and I'll see you in my next video. Invest safe.